Well, I'm going to introduce the interbank dealing range. And what that is a specific range. I'm going to show you one of the things that I do, and it's based on how the algorithm refers to old data. I want you to take a look at this area here where the buy side liquidity is. Do you see how we ran above that with this price run? And now also, can you see how this swing low here that starts this price run was taken out with this movement here? So we have two reference points. One, this is a run on external range liquidity. That's over here. And this low here is a run on internal range liquidity. Sell stops below this low have been taken out, and buy stops above these highs over here have been taken out with this price run. So that means we have a specific price range, and I'm going to show you that now. We have this new low and this high. What that is the interbank dealing range high and low. What it specifically draws attention to is the most recent run on liquidity above the marketplace, which is buy side liquidity, and below the marketplace, which is sell side liquidity. So once you have arrived at a particular swing that has done both, ran buy side and sell side. Now in this instance, you can see how price has ran buy side above these relative equal highs over here. It ran all that buy side liquidity out first, then it ran for this area here, which below that low would be sell side liquidity. So in this instance, the macro was run buy side first, then attack sell side, where it could have started running sell side first and then running buy side. But you would use whatever those key highs and lows are that runs both sides of the marketplace. You can see how we started to run higher. And once you have that dealing range, okay, the interbank dealing range means that there's going to be a lot of interest in seeing price return back inside this range to a particular price level. The line that you see here, this orange line, I'm going to outline what that is. If you take the high here that ran the buy side liquidity and then this low here taken out there, that low between this low and this high, if you find the exact midpoint, if price goes above it while inside this range between this high and this low, we are at a short-term overbought scenario. Now by itself, it doesn't mean anything. If we can draw some kind of parallel to something in this price leg when we are above that midpoint or equilibrium, then it's more salient. It's meaningful. It's something that we can take action on. Okay. Now it means that we can anticipate some measure of a decline, but that might not necessarily equate to a short. But as we go further into price action, we start a new week here. So this is all price action from last week, and Monday's trading starts here, and then we go deeper above this high and deeper in reference to this high to low. See how much higher we are up here? We aren't going back to this high. All we're trying to do is look for periods where it trades above this orange line, the darker one. So this was the initial run above the midpoint, okay? And anytime we get above the midpoint of a particular range, the algorithm sees that as a premium, okay? And what does that mean? It means that it's too expensive, okay? Or approaching expensive. Now, much like in the same idea that overbought and oversold, overbought conditions can stay overbought and the market can still go higher. So don't misunderstand what I'm saying here in saying that whenever we're above the midpoint, that's an easy slam dunk overbought or shorting scenario. You have to reference things inside this price leg. Okay, so inside this price leg, there are specific things that we look for that if they line up with time and price, then you'll see a high probability scenario unfold. You also bring in day of the week. So day of the week is when we're bearish, there's a 70% likelihood that the high of the week will form on Tuesday. If it doesn't form on Tuesday, it will occur on Wednesday. But if it does form on Tuesday, you'll still get a very strong sell on Wednesday as well. So your focus should be, where is price drawing to? Where's the next draw on liquidity? We anticipate a run below this low. It's going to leave that dealing range. Here we have Tuesday. Tuesday, we started Monday late and then crossed over into Tuesday. And then as the market makes its run above this level right in here, okay, this level here is an hourly candle signature, and it's a rejection block. We are now looking at two things. We're trading at a particular price level, which is a 60-minute rejection block, and day of the week is Tuesday, while price is expected to go lower in foreign currency and dollar higher. Price goes up on Tuesday, trades to the rejection block, and look how far we are above that orange line. Again, that's equilibrium. So anything above this line is a premium. So that's where your high probability shorts are going to occur. But you have to have it in reference to a specific price range. This is the dealing range in which the algorithm is going to work within. It doesn't need to go up above this high here because it's already done so. So the last time it ran liquidity in this range was taking out sell side. So what it'll do is it'll create short-term highs to do what? Every time it creates a short-term high and starts to trade down, traders will go short and they'll put what above this level? New buy stops to protect their shorts. Willing buyers have orders resting above this high and the market trades above that. What's actually happening? They're accumulating short positions. Who is? The interbank traders. Above this high, they're shorting. They're selling to those buy stops being activated. These individuals that were selling short, they're now neutralized. They're no longer in the market. But their order was counterparty to interbank traders that now hold a short position. Same thing. The market drops down. The algorithm delivers a small little decline. What starts to build above here? More buy side liquidity, buy stops, because now this one failed, but this one really is the high in the marketplace, so they can go short. The market trades down a little bit, gives them that little cookie, or they chase it down here and they put their stop loss above here. What kind of stop? Buy stop. The market runs above that on Tuesday, takes that buy side liquidity out, and interbank traders sell short to those buy stops. So now they have built in a bank of selling in here and in here. The high of the week when we're bearish will form 70% of the time on Tuesday. What's the high of the week so far? Tuesday. So the market trades lower. Now it leaves all of this price action right here by breaking down. So this high, this low, and this high here on Tuesday. When the market trades below here, when we start seeing it go back above this midpoint or equilibrium, this is the Wednesday selling opportunity. Remember, the weekly profile is likely to trade lower. Okay, so weekly power 3 is we open, make the high of the week on Tuesday, and then start trading lower into Wednesday, Thursday, or Friday to attack a low, to make the low of the week. Putting all this together, when we broke down on Tuesday, look at this area here. Doesn't look like a bear flag. It goes down a little bit, gets everyone thinking it's going to go lower, and then rams it right back up into the breaker. Trades on Wednesday, again, London session, then it cascades lower. Then every rally from that point on, it's only going to rally to a point of inefficiency. Now, what does that mean? Now, on Wednesday, when the market starts to really start to take off and go lower, every time the market creates a little small gap in price. Now, think for a moment, okay? The ideal scenario is dollars bullish, foreign currencies bearish. We have now made a high or potential high of the week on Tuesday, and Wednesday, it's selling off. So we can trust that this is likely to draw down to our objective, which is 117.40. Now watch what happens. This strong break here below these lows, that one singular candle right there creates a fair value gap. What is that? The market trades right back up and rebalances all the down candle, the black candle. So all of this black candle, this is the area that IPTA needs to rebalance. The market trades up into it, trades all of this down movement. In other words, think of it like a paint roller. Okay, you get your paint roller, you put it in the pan, collect a lot of paint on it, then you apply the roller to your wall, and if you keep rolling enough, eventually you'll start seeing little pockets. Well, imagine that paint roller here starting, and it's starting to go down, okay? And then this is one of those little pockets. So if you see that, what are you going to do with the paint roller? You're going to leave it like that? No. You're going to roll back up to fill in that little area. That's what's going on. Every price range needs to be efficiently traded to, okay? And if you ever studied auction theory, this is the real version of that, because auction theory is just part of it. When markets deliver on the downside, to efficiently deliver that price between the high of this candle and the low of this candle, there's an imbalance from the previous candle's low and the next candle's high. It only went down between this candle's low and this candle's high. It went down. Notice that? That's what I'm highlighting here. So going in the future, at some point, the market's going to go back up and offer buy side delivery. So this is sell side delivery where the market's going down. For that range between this candle's low and this candle's high to be efficiently delivered, the algorithm has to go up between this candle's high and this candle's low, and it does so there. Once that occurs, this becomes a balanced price range. What does that mean? It's balanced. It's not imbalanced. It doesn't need to go any higher than that. It can, as you can see a little bit here, but that's the hierarchy of order flow. You have to understand how, if a market has delivered an up candle, at some point in the future, it needs to come back down through that same range to offer sell side, and vice versa. So this in itself could be a target, or in this case, it could be an entry strategy. So you could go short here and anticipate price going lower. Very, very similar thing happening here. We have a low and a high, and the market goes right back up into and delivers all this downside. It gives it buy side again, and it rebalances. And then what happens in price? It trades lower until we get to what? FOMC. So we have FOMC nonsense at 2 o'clock in the afternoon. It goes back and forth, whips around. That's normal because it's clearing both sides of the marketplace. It's clearing the stops above this short-term high, and it's clearing the stops below this short-term low. So everything has been cleared. So now no one on the short term is holding a position. They would have to have their stop way back here. And then the market starts to do what? It creates its downdraft again, because what is in play? Lower currencies, higher dollar. So we see it again. We have a low and a high right in here. There's an imbalance. That's a fair value gap. So sell side delivery has been offered. So in this candle, it goes right back up inside the pocket of this high and this low. That right there is another shorting opportunity. You can get short there. You can place a stop loss above here and walk away. The market trades back up, trades deeper into this area, not by much above that, but you can see all the way to the point of this candle here. Let me add it so you can appreciate it. But this is where, if you take the trades using this, you can suffer some time delay and a little bit of drawdown. Like, for instance, say you sold short here. You'd have a little bit of drawdown in this candle, this candle, this candle, this candle. Might got excited a little bit there, thinking it's going to finally break, but it goes all the way up to this level here, doesn't completely fill it in yet, and then finally gives up the ghost and trades lower. You see that? So all of this area here doesn't quite get filled, but then it breaks this low. When it does that, that's indicating that this right here is a really strong indication that we're going lower, and it's probably not going to come back up to this price level. We're going to probably see much more pronounced delivery on the downside. And market creates another run below this low here. So we have this low and this high. So what's actually happening here? Same thing. Prices going back up into this candle. Now here's a real gem, okay? This low and this high. Price has went down, gone up, and then down to this price point right there. You see that? So all of this is a balanced price range. The market has been delivered on the downside, and then it's delivered on the upside, and it's down again. So when the market trades back up here, it's not, listen folks, this is really important. It is not support broken, term resistance. That's what's going on here. That's not what happens. If you're looking for key support and resistance levels, if you have this signature here where it breaks through it, then comes back, that point where it does that, then yes, your support and resistance theories will work there. But whenever it doesn't have this, and you're trying to find a old low and you're looking for it to be broken and you're looking for resistance, it's not going to work unless it has this. For support and resistance to work, it needs to have this little signature right there. Okay, it's an overshoot through that old low after it has shown a balanced price range. And again, a balanced price range is where price delivers on the downside and the upside. So what do I mean by that? The market has offered time and delivery on the downside. So anyone that wants to sell with that movement, they had an opportunity to do so. But what about the buyers? They didn't really get a real good chance to buy at their price levels. So the market goes up and allows that to take effect. Okay, but what's going on there? As this market's been going higher, anyone that wants to sell below these lows on a break, they haven't had the opportunity to do so because the market keeps going up. Well, they've been now given that opportunity here. See, that delivery of price is balanced back and forth. Right here, we have an opportunity to sell off, and now the market starts to cascade again lower. Here you have a bear flag. Ooh, look at that. Classic chart pattern. And right into what price level is that? 117.40. Now, to get 117.40, it's got to go a little bit below that, right? What's the low? 117.37. There's your spread. What happened after it traded there? Did it rocket through that? Did it dilly-dally around? Off to the races. Rejection block. Let's go to the hourly chart. Highest up close. That's what I'm highlighting there. It trades to that and then rejects. Breaks this swing low. This is a breaker. Okay, right in here. And it's also your point of reference for market structure being broken. Now, why 117.40? See all these lows? What's resting below that? These lows, all of them have been reference points for trailed stop losses. What kind of stops? Sell stops. Right in here, you see a series of down close candles. That starts your bullish order block. There's a small little price action segment right in here that's a gap. That's that fair value gap. You're trying to tell me? No, I'm telling you. So if we go to a 4-hour chart, what's this candle here? That's the last down close candle before this move up. This last down close candle's high comes in at 117.41 and 3 pipettes. So if it's going to reach down in here, I'm going to round it to the nearest round 10 level, 117.40. We have liquidity below here, and then bam, we tag through it, and there's your run. I like the idea of a percent R still. If I had to talk about a overbought oversold indicator, if I was going to do that, this would be the one I would use because it makes sense to me. But if you look at the percent R, we're overbought because we're above the midpoint of this area here. This should be an overbought reading in the percent R. It is. This should be an overbought. It is. This should be overbought. It is. This should be overbought. It is. I don't need an indicator to tell me we're overbought because I'm looking at the range that matters most. And then clearly within that context and a narrative that I'm bearish euro, bullish dollar, I have a target. Where's it going to draw to? 117.40. So the market trades up into that range here, not taking the high out. It's just moving into a deeper premium. And then what happens? The algorithm on Tuesday sets the high of the week. In summary, you want to look at where the most recent dealing range has traded. Did it take out buy side liquidity? Did it take out sell side liquidity? You need to find those two most recent demarkers. And once you know that, that's your current dealing range on an interbank level for any time frame. Using a 15-minute time frame, that's like my bellwether. I can find a lot of setups with a 15-minute chart. And if you use an hourly chart, you'll come up with a different dealing range. So don't think, well, what happens if I look at the 4-hour chart and then that doesn't look like it does this and that? You trade the time frame that you're looking at. The narrative is already in motion. Modest higher prices in dollar, lower foreign currency prices, and this is our dealing range. Okay, so you use last week's information to tell you what this week's going to do. Tuesday's high of the week, 70% of the time. And you can get a really good sell signal on Wednesday. There you go.